Okay, let's get started. Thank you so much for joining me tonight for our quarterly market update. This one is eventful as I feel like they all are. Always a lot of things going on. Tonight, as always, if you have any questions during the presentation, feel free to hit the raise your hand icon, or you could do the just put a little note in the webinar chat feature. Happy to answer any questions as we go along, or if you want to ask them at the end, more than fine. Tonight, I'm going to start with the economy, and then I'm going to trickle it into the markets. I wanted to start with just kind of going over a concept that I wanted to make sure everyone really grasped. There's the economy, and then there's the stock market. Now, they are loosely correlated over time, but they certainly cannot match up over 6 months, year, 18 months. A lot of it, because we're humans, we have fear gets into the equation, greed gets into the equation. So a lot of times markets can overshoot, can undershoot, can, 1 year really be focused on X, and then 3 years later, X is playing out and markets don't react to it. So over any short period of time, always be skeptical of, if you have CNBC on or hear some economists saying, oh, because of XYZ, market's going to tank or market's going to go up, 10% over the next few months. All they're really telling you is based on probability. What they're saying is when these scenarios have played out in the past and the markets have these level of expenses based on their earnings, and you can look back at the last 100 years, well, this should happen. This is a high probability of happening. And of course, there are certain scenarios where you can find yourself between a 60% probability of happening, 70%, 80%. I think Goldman Sachs just tweaked their probability of a recession in the next 12 months from 35% to 25%. So they can't say with any degree of certainty. They can only tell you how high their probability is based on the past. But, a point that I wanted to drive home was if we compare earnings versus the stock market, this is our GDP. This is what we're doing as a country, how much we're producing. It's fairly stable over time. Now, this is a roughly a little over 20-year period that actually had two of the most seismic realities play out in history. We had COVID, so really nothing really looks like this much of a decline on this chart on the left. And then we had the 2008 financial crisis where the whole world collapsed. Other than that, earnings are fairly steady in terms of a growth rate. Why I have so much confidence in the stock market and companies over time is it's fairly predictable. So we had inflation ate into profits. So they raised prices and revenue went up to make sure we can maintain profit margins, and business is sustained, earnings is sustained. Or maybe some companies in certain industries felt like they can overextend themselves and increase what they were charging. Well, companies eventually come in and undercut them because they could do it at still profitable at lower rates. This is why over time, no matter good or bad, markets tend and companies tend to fall back into a trend that's fairly predictable. And what we were starting there was just a simple 2% growth rate over time, and everything kind of gets back to that trend line. In saying that, if we look at stocks rates of returns over that time period, because markets have exposure to assumptions, as assumptions to fear, greed, some things could play out, the debt ceiling, whatever it is at the time. We've had markets that are year to date up 15, last year down 20, up 26, up 16, up 28, down 6, up 19. So this is why year in, year out, there's a healthy part of this is just the human experience of fear and greed and assumptions of certain things play out and probabilities. But over time, everything kind of gets back to that trend line growth. I don't have it pulled up right now, but there's a great video you can find online by a investor named Peter Lynch. He used to run the Fidelity Magellan Fund. I think it was in late 1980s or early 1990s. He pretty much told you, over the next 30 years, I can't tell you what's going to happen in each one year, but if companies produce X earnings and it goes at a certain growth rate, that the stock market should do 8% over time. And I think it was like last year was the 30-year anniversary of him coming up with that prediction, and he was off by 0.2. So yes, year in, year out, you could freak out, get uncomfortable, there's frustration, and other times things are going great. You think the sky's the limit. But over time, stocks are fairly predictable. Looking at the S&P 500 over the last 15 years, 9%. Over the last 10 years, 10.25%. The last 5 years, 9.8%. The last 3 years, 11.7%. Now, over times, you can certainly have stretches of 5, 6, 7, 8 years a little bit more muted, typically followed by 5, 6, 7, 8 years a little bit more above average, but they tend to go back to trend. The key to stocks in those really uncomfortable times is just staying calm and leaving it alone. That's certainly the name of the game, in my opinion. So that was a little extra tangent. Maybe it's not wanted, but I hope you got some value out of it. Just my take on stocks and time, more or less. So let me share my screen again, and I'll get off my soapbox, and let's go through the economy. Now, what has been the story over the last couple years? Inflation. Markets completely freaked out last year, and last year is a perfect example of what I was just talking about. Companies' earnings were pretty much flat. We did okay. It's a reasonable year. Nothing to shake out about, pretty much even. And the stock market lost 20% because of fear and expectations of what's going to play out next, and a lot of uncertainty. And when uncertainty goes up, markets freak out. So we had two big uncertainties. We saw the runaway train of inflation getting close to double digits here. We peaked at a little over 9%. And of course, the Russia-Ukraine thing, the first, land war in Europe in almost 80 years, with a tremendous amount of uncertainty around both of them. Well, here we are, a year and a half later. Companies, countries, individuals tend to figure things out. So we have a situation in Europe, of course, it hasn't gone away, but all the big scares of, what happens, how are we going to get oil, how are we going to get natural gas? Everyone shifts around, everyone figures it out. Not that it's gone away, but the catastrophic risk playing out has certainly diminished as of right now. Of course, things can ramp up again, but markets have certainly cooled to the Ukraine-Russia nervousness. And then inflation is done similar to what it did in the 1970s. Peaked up and more or less looks exactly the same on the way back down. So we're at 9%. Inflation numbers just came out today. CPI is around 3%. So we are certainly seeing what we hope. And the reason we hope that is because the higher inflation stays, the more the government's going to have to raise interest rates. The more they raise interest rates, it eats into the economy, eats into profits, and then typically sends the stock market down with it. So we are certainly seeing the trend we want to see with inflation. Now, the tricky thing with inflation is, if we go back to the 70s, the government took their foot off the gas. They cut rates when the economy started to get little hiccups, and then they had a double dip, and it went right back up to those levels. The Feds have made it very clear they're a student of history, so hopefully that doesn't continue. Over the next few months, we might have to take our medicine. Some of the earnings are going to probably be a little bit on the downward side, but it is a necessary evil to, deal with a little bit of lumps as opposed to a double dip, deeper recession type problem. In the 70s, a decade of economic activity kind of got wiped out. So hopefully we can continue down this path. Time will tell. There's a lot of conflicting forces that are keeping things relatively flat. So, all right, interest rates have gone up. Hopefully we won't have to go up too much more. We're right now at 5.25 as the Fed funds rate, which is pretty high compared to the last 15 years of close to 0. Now, last year, the markets freaked out because of a potential recession, understandably so. Anytime the governments have raised rates that much in the past, a recession did come. But this has been like a year and a half in the making that everyone's kind of prepared. You don't have a lot of companies spending willy-nilly right now, and they haven't been for a long time. So what we're looking at right here is what we would call the 4 horsemen of a recession. Normally, one of these categories have gotten out of hand, and a bubble is going to burst. Nothing's really gotten out of hand. We have housing starts on the top left, vehicle sales, inventories, and business kind of investments and research and development, things of that nature. All of them are floating at or below their long-term average. So it's kind of hard to have a deep recession if none of these things are really at lofty levels. So most economists, I would say, are saying not in the next 2-3 quarters that we're seeing any sort of really big contraction, but a little bit more dicey a year out, but they see it as a shallow recession, which again, I do too, because when you look back at history and where things stand today, that has the highest probability. Will it play out? Time will tell. No one can tell you with a 100% degree of certainty, but that's where the economic data is pointing to in terms of a probability. Now, one of the things that I'm not an expert in is, real estate and kind of housing, but the reality is, if we're looking at the top left here, really since the 2008 financial crisis, single-family housing starts have been below average for a very long time. The inventory is extremely low. So if you're out there, you think the housing market's going to crash and, we're going to have a big correction at some point soon. It's kind of hard for that to happen. It's supply and demand. If there's not a lot of supply out there, demand is going to be high. So there's a lot of, still today, I was actually kind of surprised because we got mortgage rates of 6-7%, and a house 2 blocks down from me had an open house with 15 people and had apparently the new reality of the day is, open house Saturday, best and final on Tuesday, which is just a crazy concept to me. So, but this is the times we're living in. I don't see housing prices crashing anytime soon. Can they go up more? That's also a tough reality. But a stabilization at these levels seems the most reasonable scenario to me. Now, of course, every geographical location is unique. So, San Francisco is going through its own unique thing. New York's going through its unique thing. Florida's and Texas, those are big demographic changes. These are more just national comments. Now, something I get every single week is normally someone reaching out to me having a new idea of something that's going to do well, or some reason to be, scared out of your wits and want to hide under your bed. Most of it is noise. In my opinion, there's probably a few main things that you could put in this category. Of course, like a nuclear war type of event. Saudis have a lot of control in oil, but that's kind of also in their interest. One of the biggest things that I would be concerned with in the long run is our reality of our national debt. We're 32 trillion dollars in debt. This bottom right corner percentage of our GDP, we're crossing over the 100% mark, meaning our debt and what are producing is at the same level. And when you look back at history, it only was that high during World War II, and understandable, we're fighting a world war. Our spending is getting out of hand. This chart here on the left is our total spending, and this is the money we have to spend it. So we're spending 6.2 trillion. Let's break this down. Medicare and Medicaid and Social Security is half of what we're spending our money on. Now, it's nice to say half, But when you actually look at what we're bringing in, this column here to the right, it's over 60% of what we are spent in terms of the money we have coming in. 60% of that is going to those three things. Now, it's glaring to anyone who knows first grade math that something has to be done with regards to those things. You know, I had a bunch of people say, I'm really concerned about the debt ceiling. You know, the debt ceiling is, you know, like you're on a beach and it's raining and there's a 100-foot tsunami coming down. Just no one knows if it's going to be 5 years, 10 years, 40 years, or, you know, 100 years. But the rain's not the big deal. The rain's garden variety problem that goes away. That tsunami is a little bit different. You know, 31 trillion in debt. And the biggest reasons we're there, Social Security, Medicare, and Medicaid, which are going nowhere but up in terms of a percentage of what our budget is. In the debt ceiling talks, not one politician was willing to even think about addressing them. That's a problem, because it's not if we have to do it. There's a 100% probability we have to do it, but the people we put in place on both sides of the aisle are ignoring it, because I get it, it's political suicide to touch it. But this is going to be a problem at some point. Now, it's a scary thing, and it might not even happen over our lifetimes. You or I don't know that, but it's like musical chairs that the music will stop one day. We can't keep spending at this reality. You know, luckily, we've been the world power for 80 years and no one else has even come close. Well, now we're having a little bit of a dual world order when it comes to China. Now, China has a boatload of problems, and it's not easy being the number one. There's a lot of responsibilities. We have rule of law. You know, people, you know, I get this all the time. China's here and it's over. No, it's not by any stretch of the imagination. You know, it's not easy to accomplish what we've done over the last 80 years in terms of rule of law, in terms of growth. We have a lot of things in our favor between just the size of our land, the oil reserves, the gold reserves. You know, for all the faults of our political system, it does have some decent checks and balances in place. But we will have to face the music at some point. You know, we're borrowing 23% of our reality. You know, as we talk about the debt ceiling, you know, all right, we're not going to touch Medicaid, we're not going to touch Medicare, we're not going to Social Security, we can't touch defense, and we can't touch the interest on our debt. Well, that's 100% of what we take in. We would literally have to cut almost everything else we spend our money on to balance the budget. So we have a tough road ahead of us as a nation, without a doubt. What does that mean for you as an individual? Now, I tell people there's a few categories of things. We have things that do not keep up with inflation. We have a bucket that maintains with inflation, maintains our purchasing power, and there's items that grow above inflation. Bucket one, cash, is the only thing that I guarantee you over time you will lose. Over the last 100 years, 97% of the value of the dollar has been lost. As sure as I am that politicians don't want to touch Medicaid and Social Security, and we're going to balloon into higher and higher debt, they're diluting the currency. Now, that's a long-term trend. The US dollar went up in value last year. So you could sit here and say, but I thought it's going to crash. No, these things can play out over 10, 20, 30 years. But the trend is not in our favor. There couldn't be short-term spikes, which there certainly will be. You know, things just don't go in a perfect line in certain directions. But over time, the value of the dollar is going to be, you know, worse and worse. You know, this is why I tell people you want to have an emergency fund. You need some liquidity if, God forbid, something goes wrong. But besides 4, 5, 6 months of your fixed expenses, plus any one-time purchases coming up, I don't have a penny more in cash because I know it's dead money. Then you have things that maintain with inflation. What I would put in that bucket over time, your personal residence. You know, yes, everyone had a beautiful windfall over the last few years because inflation took off and there was underbuilding. But over time, maybe you make about 1% above inflation on your primary residence. But when you factor in realtor costs and the wear and tear on the house, it's probably around break even with inflation. But it will maintain with inflation. So certainly, is there going to be equity in a home or cash in the bank? I like equity in real estate. CDs will maintain with inflation. Everyone's excited to get a 5% CD. We have 5% CDs because inflation's 5%. When inflation comes down to 2-3%, CDs will come down. So they're fine. Everyone will talk about, in the 70s and 80s, you had CDs paying 10, 11, 12% because inflation took off. But just know CDs aren't bad. This is good for money in the 2, 3, 4 year time horizons. But it's just maintaining with inflation. Now, really, bonds might give you 1% above inflation, similar to real estate. Maybe if we're lucky, 2% above inflation if interest rates are trending down over time. But mostly in that bucket, like I said, your primary residence, CDs and bonds are more or less inflation and purchasing power maintainers. Last bucket, the buckets that giving you a yield, a rate of return above inflation, having your own business, rental real estate, and the stock market. Those are things that over time will not only maintain with inflation, but give you a return above inflation. Obviously, those should be a lot longer of a time horizon. You can't really jump in and jumping out of, commercial real estate. These are long-term things that add value over time. So they all have their place. You should probably have a little bit in all three, but it should have the appropriate amounts with the appropriate time horizons. Now, something I go back and forth on personally is, where does gold fit into the mix? It's hard to peg down gold. Gold has had value for 10,000 years, which is nothing to sneeze at, or similar to Bitcoin. These are unique asset classes, unpredictable asset classes. The history of gold the last 10 years had a humongous spike around 2012, 2013, and it was dead money for a decade. And now it's spiked up again. So if you like gold, which nothing wrong with that, you have to be, that's more of a 10, 20, 30 year, my whole life mentality, where I'm going to put 2 to 10% in gold. And I just believe in it in good times and bad, because there are going to be bad times and there'll certainly be good times. But it's a long-term play. No one should be going into gold thinking I'm going to make a pop over the next year or two. Gold is worth what people are willing to pay for it. That's it. This is why Warren Buffett doesn't like gold. There's no cash flow, there's no interest, there's no dividend. I can't do a formula to determine a growth rate and to see a trend. He would never touch it. There's other very smart financial people that think it's great. I'm somewhere in the middle. I don't mind if my clients like it or don't like it, but it should be a hedge. 2 to 10% is a reasonable amount if you're going to do it. I'm starting to lean more towards liking it, with the backdrop of, we're $31 trillion in debt. We're going to be printing more money. It's been a hedge over time. Bitcoin, you could say a lot of the same things, but certainly the roller coaster ride will be much more dramatic. You or I don't know, China came out last year and just said, boom, we're done with it, get it out. Who knows what the feds are going to do? If you have a couple of those, more of those company go belly up, you just don't know. So I wouldn't buy it if you're saying this is my hedge. This is a part of your portfolio. This is my speculative money, where I would never put 10%, but a few percentage. If you just want to say, I'm either going to hit a grand slam or strike out, that's what the sleeve I would put it in. And it's part of that third bucket, that larger rate of return, trying to keep up with inflation. It shouldn't be money you need in the next year or two. So one other reason that we're probably due for a shallow recession, or more of a flatlining of the earnings reality, is the jobs market. So what you're looking at on the left side is jobs posted. So we're still at 10 million jobs posted for about 6 million people looking for work. So even if, millions of jobs no longer become available, you're only going back to a reality that's normally good, 1-to-1. So where you have an undersupply of housing, companies are still looking for jobs. And like I told you, those four horsemen of the economy, housing, cars, inventory, and research and development, none of them are crazy expensive. So on the economy side of things, I could see more of a, if it's up, down, or sideways, certainly a sideways reality seems reasonable to me. Now let's tie this into the stock market. Now, what I just said was the economy could be flat. Now, with the economy flat, stocks can go up 20% or down 20% from these levels, and it'd be perfectly reasonable. And I'll explain. So what we're looking at right here is stocks over the last 25 years. Okay, the big run up of the tech bubble and the markets crashed. Big run up to the 2008 financial crisis, market crash. It's followed by the longest bull market. Bull market is a period of time where we're going up without a 20% correction. And that got us all the way to COVID. So this is where we were right before COVID. Something all of you've heard me say many times is this equation here. This is the multiple we're paying to own stocks. And I always give the example of a rental property. You want to buy my office. Let's say it rents for 10 grand a year. You go do your homework and you see what other properties are renting for. And you come back and you say, Mike, the average, what people are paying for rent is about 15 times rent. So you say, I want to buy this from you for 150 grand. And I say, let me think about it. And then we see in the newspaper tomorrow, Fairfield, New Jersey is going to get a train station right to New York City. Well, we both know I'm not going to sell it for 15 times rent anymore because the land's worth more money. So based on that rumor, I'm going to ask 20 times. Let's say, oh, that gets scratched and because there's a big flood that blows everything up and now no one wants to come to Fairfield. Well, I'm not going to get 20 times anymore. Probably not going to get 15. Maybe I'll get 10 times. That's what the stock market does. So what we're saying is 2008 financial crisis, no one wanted to own stocks. Everyone was afraid. You could have bought stocks at 10 times earnings. 25, just based on this chart, is really, really high. Now, it doesn't seem unreasonable when you see 19s here and 21s here, but 25 in history in the last 120 years looks like a pretty big outlier. But what does that really mean? Why is it such a big outlier? Think of what happened during that time period. That was the tech bubble. What does that mean? Anything that said the word internet or computers or technology, IPO'd at 50 and then went up to 150 the next day. Even if they didn't have earnings, the price went up. So what is the equation? The price divided by earnings gives you the multiple. So if you have very little earnings and the price is going up, that means the multiple's getting higher and higher to unrealistic levels. So over history, 20 is on the expensive side for the north side, 10 is certainly on the cheap side, 16 and change is about average. Now, that doesn't mean it can't stay expensive for a long time. This whole window here from 2017 to 2019 is floating at 18 to 19 for years. Where are we right now? At 19. So like I was just saying before, stocks can go up 10, 15%, and that wouldn't be unprecedented. Even in the last 5 years, it wouldn't be unprecedented. Can they go down 10, 15% and still be reasonable? Nothing wrong, economy's fine, everything's okay, but it just corrected down to a more reasonable multiple. It just went from 19 to 17. Very reasonable still. So this is why short-term realities are very hard to predict. It's a lot of just kind of swings in the market that aren't based on real news. CNBC and all these guys try and say, oh, the market dropped 1% today because of this. It could have nothing to do with that whatsoever, but they have to make the news, so they'll fill the slot. So just to kind of recap where we are, we were at a multiple of 19. Obviously, COVID happens. We shut off the economy, fastest decline in history. Government prints $10 trillion. People realize, well, if it goes up, we get to keep it. If it goes down, the government's just going to write bigger and bigger checks. screamed up at the fastest pace in history and kind of overshot, hence where we got up to 21.5. Inflation stepped in, Ukraine problem presented itself, markets corrected about 25%, Ukraine calmed down, inflation has calmed down from 9% to closer to 3%, stocks have had a tremendous rally. So really, we just got back on trend, really from 2008 till today. You could almost get a straight line, and we right back to where we were in terms of the multiple we're paying. Although it's the same multiple, we're in a different world. And the reason I say that, and we'll go through a few slides that cover it, well, when you thought stocks were expensive, what'd you do? You say, you know what, I'm going to go to the bond market. I'll just park my money over here and collect some interest. Well, for the last 15 years, that interest has been about 2 and change. Well, now that interest is 5 and change. That's a pretty good option too in today's reality, especially if the economy gets a little shaky and interest rates go down, the value of those bonds are going to go up. So I had been taking a little risk off the table because we have a good option too. If things fall apart a little bit, stocks are a little too expensive for these levels, and that option 2 will give us a 2-banger, nice yield with some appreciation. But right now, stocks are what we would consider little on the expensive side, not crazy over the top, but a little expensive. This is really just driving the point home, because what you're looking at is, like I said, 16 and train's been the average over the last 25 years. So you're 60% of the time, or one standard deviation is a little less than 14. So it's 13 or as high as 20. So this is kind of normal ebbs and flows. If it goes above this, hey, this is getting to some lower probability scenario expensive and probably will correct. And same on the downside, you can see down here in the 2008. You're probably looking at a pretty good time to buy where you bought stocks that cheap like they were in 2008. Going back to my overarching theme, why you can't predict short-term, but long-term stocks are relatively predictable, is a chart I've gone over many times, is this right here. So this is your forward PE. So what that simply means is what we're assuming earnings are going to be over the next year. And so if we have a 19.1, well, we've seen scenarios where stocks went up, call it 25% from these levels, and we've scenarios where they've gone down 20%. That's a pretty big spread of what could happen. Now, the chart on the right, where I say, well, don't look over in 1 year, let's look over a 5-year period, those rates of returns become much more into a narrow field. And this goes back to the trend that I'm talking about. If we're buying stocks at cheaper levels, 8 times earnings, 11 or 14, the slope is a little bit up to the left, normally a higher rate of return in a more predictable fashion. The more expensive that multiple gets, the slope goes down. It's still a decent spread. So from these levels here, you've seen average rate of returns over the next 5 years of around 10% a year and closer to flat. So again, all it is a narrowing of the realities that could typically play out. Now, one thing that looks similar to the tech bubble is you had one segment of the economy do very well in terms of stock market performance and kind of get a little bit past themselves. So we had the big technology names, or what this is showing here is the PE ratios of the top 10 stocks. So now that also happens to be technology names, mostly your Metas, your Amazons, your Microsofts, your Googles, your Nvidias now entered the mix. The multiple you're paying to own those is getting similar to where we were in the tech bubble, and they crashed back down to earth. Now, there shouldn't be that much of a spread. These are big developed companies. Their growth rates are harder to sustain when you get bigger and bigger and bigger. And so, but the story has been so great of just own the FANG stocks, and that works until it doesn't. And normally it comes violently down. So last year it went violently down. All your big names lost 40, 50%. they spike back up again. So this is something where, if you are holding some of those big names, I'm not saying you get rid of them, but I would certainly take some profits, trim your positions a little bit of those kind of big tech names. Inside of my portfolios, I have more of a value tilt. Really, over the last 100 years, growth is a lot more fun. It's a lot of sizzle. Hey, who knows, where the market's going? This is the trend. This is what I want to go to. Most of the time, that's very hard to nail down. You say, oh, this sector is going to be great. Maybe, but when there's a lot of optimism around there, what that really means is people are willing to buy the stock, even though the early earnings aren't there yet. So newer industries are going to be smaller company stocks. So what you're looking here in the top right is percentage of unprofitable companies in the Russell 2000 or smaller companies that are public. This is the ones that are unprofitable. They're not making any money. This was the tech bubble. Again, the poster child of you're buying companies that aren't making any money, and a lot of them will never make money and can go bankrupt, has kind of crept back up to that reality. Your value players are a little bit more predictable. Just to briefly go over value and growth. Growth is you just think something's going to grow very fast, where the earnings might not be there, but the growth rate is going to be great, so it'd be worthwhile. The earnings will catch up down the road. Now that's hard to gauge. It's like Nvidia stock is the darling of Wall Street right now because of Chat GPT and artificial intelligence. It's got up 200-300% in no time because of where they think the world is going to go and how profitable they're going to be in the future. Well, is 300% increase right? Should it be 200? Should it be 150? Should it be 1,000? It's very hard to gauge that. Value stocks, much more predictable. Stock investing is much more of, not striking out than it is to realizing give up the home run so you don't strike out, but you are going to be limited to single and doubles. Value stocks over time, whereas the process of you think Home Depot is trading at $50 a share, and based on their earnings should be trading at $60 a share, you believe it's cheap compared to where it should be. Value stocks over the last 100 years have outperformed growth at about 3% a year. Now, it's not going to go 3% every year. There's going to be periods of time where growth does fantastic and value underperforms. Of course, vice versa. But if you're a long-term investor, a value tilt tends to add value, and especially where kind of growth stocks are right now and where those top 10 names are right now, growth is at a pretty big run up. Probably over the next 10 years, value should do very well. I brought up in the last conversation that this will probably look like a W if we dip into a recession. That is still my base case. So you saw in the stock market, we went down 25-26% last year. We've had a nice rally since. There doesn't seem to be enough things that I think could push up the stock market from here at a meaningful pace. Because as we sit here today, like we just said, it's either the multiple or earnings go up at a crazy pace. Well, multiple's already at 19, that's above average, and we have a reality where bonds are paying us 5.5%. Well, multiple expansion seems tough to justify, and earnings with interest rates going up as much as they did, with the banks increasing their standards because of a couple banks going belly up, it's hard to push earnings up at a fast pace going forward. So, it'd be very odd for us to go into a recession in 6 months and the stock market to a bottom 6 months ago. So I'll take markets going up whenever I can get it, but I don't think, in the longer term trends of a typical cycles, the downturn over a year and upswing over 5-6 years, I don't think we've cleansed enough to the downside to justify taking off on a new bull market. That doesn't mean crash, but that could easily mean a situation similar to your 2014 to 2016 time horizon, where we just kind of flatlined for a little while. Now, like I said, stocks really over the last 3-4 years have still given you a pretty good rate of return. Now, everyone mentally thinks of where we were at the very top, because everyone always thinks of the top as, how to value everything. But we are at a pretty good level here. Markets are pretty expensive. Over the last few years, we've had a pretty big run up. So more of a digestion period of a little bit of a flattening. I really wouldn't be surprised if we see something like that. Now, to transition over to the bond market. Now, everyone on this call is pretty close to retirement or at retirement, aka we have a healthy amount in bonds. 20, 30, 40, 50% in bonds for most of you. So it is a very crucial part of your investment return and your investment mix. So let's just break down bonds a little bit. So what we're looking at here is the Fed funds rate over time over the last 25 years or so. So like we were saying, inflation took off, so the government raised rates at the fastest pace in history. Now, I'm going to give you the example of your bonds versus your kind of money markets and CDs. Because a question I keep having come up, why don't I just put it in CD? It's paying 5%, or money market's paying 5%. No risk. I get that. Now, when you look back at time, the worst year ever for bonds was 1994, where they lost 3%. Following year, they went up 19%, because some of bonds gets interest and some of it's from appreciation. So there's 3 ways interest rates can move. So we have interest rates going up. So we were doing 0.75, 0.75, 0.5, big moves. Now we're maybe every other meeting doing a quarter for a couple more meetings. Very small moves compared to the recent history. If you're at 2% and you're raising 0.5%, that's a 25% increase. If we're already at 5.25 and we're moving it a quarter, much smaller percentage increase. So let's assume we're done with rate increases. And so this is where you wanted to be in CDs and money markets, because you didn't feel the pain of your principal losing. I get that. It stunk. That was the worst year on record for bonds. Unbelievably painful for my conservative investors that haven't experienced anything like that in decades, really since the 70s. Well, all right. Part 1, interest rates up, bonds lose, CDs and money markets win, because you didn't have principal loss. Well, if interest rates go sideways, all right, bonds yield 5.5, CDs 5.5, that's a wash. So at this point now, it's tomato, tomato, money markets, CDs, bonds, if interest rates go sideways. If interest rates start to go back down, well, now it's the opposite of the first half. Well, you're locked into your 4 or 5% CDs or money markets, and you're still collecting that interest from the bonds, but that bond's value is going up. Think about it, if you have a 5% CD and now, a 5% bond, and now everyone else can only buy bonds paying 3%, yours is worth more money. So the value of the bonds go up. So you have the interest or coupon payment plus the bonds going up in value. So you want to be in bonds if interest rates go down. At the very beginning of my conversation, I brought up the fact of bonds or all different types of asset classes. You always have to compare it to inflation. This is where I was talking about with CDs and inflation. What are we really dealing with? So this is 1958 till today. The yields on the 10-year government bond or 10-year treasury, the average is 5.7. Inflation was 3.6, so the real yield was 2%. Now, it's not going to be that high going forward. This is why I mentioned that maybe get 1% above inflation. But what are we dealing with now? 10-year treasury is 3.8. It's actually about 4% right now. Inflation was a little over 5. We're losing money in bonds and CDs and money markets. It's great that we're getting this return, but don't kid yourself, inflation at this high. We're always concerned about purchasing power. This is what everything really comes down to. So we always want to be thinking, really in the long run, to break even, I got to make 3%. That's the way you want to think about your kind of net worth. Unless you think the government's not going to spend money at this pace, then don't worry about it. But I'll take my chances that that's not going to happen. Now, one of the things I've also done a little bit of shifts towards is international. So like everything else, things tend to ebb and flow. So the purple here is kind of when international stocks outperform. The gray here is when US stocks outperform. US stocks have kicked butt, mostly because of your big FANG stocks, Apple, Google, Facebook, Microsoft, things of that nature. And so we had more or less the biggest and one of the longest duration where we've done better. That's kind of set up a period of time where international stocks are much, much cheaper compared to us. There's a few things that I'll go over. So going back to our PE or our multiple, I was talking about one standard deviation or things that happen 60% of the time. We're pretty getting close to 2 standard deviations where it's like 95% scenario of how cheap international stocks are compared to US stocks. International dividends are above 3%. Ours are below 1.5%. What you're paying for your what we would call book value of a company is a 50% premium for US stocks. So this is probably a time over the next 10 years where international and emerging will probably do a little bit better, especially as our US currency goes down. This will probably be a period of time where value stocks do a little bit better than growth. Now, I always want to take it back to some long-term thinking of how you approach stocks. What we're looking at right here, the red is within that year, what was the biggest decline we saw and where did the stock market finish? The perfect example is everyone got afraid of the debt ceiling talk. I got a few emails, hey, Mike, I want to go to cash just because I don't know what's going to happen. And here we are up 15, 16%. You got to stay away from the head fakes. They're always going to be there. There's always going to be something where it's going to pull back the stock market 5, 10%. Like I told you over time, stocks find a way, and companies find a way of being profitable. You throw a labor shortage, they figure out ways with technology and robots to figure it out. Oh, the price of their goods are going up. They'll increase prices to kind of figure out where they need to be. They tend to always get back on track, no matter what is really playing out. Sadly, I have more faith in companies' ability to do that, than any government in history. Corporations have one sole focus. That's why they're typically pretty good at accomplishing it. Oops, sorry. And this always is kind of the slide that I bring everything home in. Stocks over any 1 year period of time. So stocks are in green, bonds are in blue, and a balanced approach, which everyone here is in a rough balanced approach, meaning some mix of stocks and bonds, is here in gray. Now, last year's a perfect example, was pretty much down 15% in your average balance approach because bonds were down 12, 13, the stocks were down about 20. Now, over time, the rates of returns have been about a little over 8 and change for your average balanced portfolio. That's a pretty good return. So as long as you can sit here and say, all right, I understand every once in a while, there's going to be 1 year that kind of stings a boatload, but over every 5-year rolling period, there's never been a time where you've lost money in a balanced approach if you just stay calm and relaxed. Let alone every single one of the clients on this call today, we stay disciplined, we buy stocks as they cheap, and we ride them up until they more or less become more profitable. So, stocks you have to think about over decades. Ignores the CNBCs, the short-term noise. There's always going to be painful parts, but they do well over time. We just have to kind of leave them alone. at this point, if anyone, I know I went over a boatload and it kind of went on a few tangents in the middle there, but if anyone has any questions, I'm happy to address them. Like I said, feel free to raise your hands or just put a note in the chat box. All right, Mark. Hey, Mark, I just, you should be able to speak now if you unmute yourself.
So, hi, Michael. My chat box was disabled for whatever reason, so I couldn't send a chat. But how does your plans work if your clients have, let's say, $500,000, or another client has $2.5 million that you're dealing with as total?
That is a loaded question. Give me a moment. One, with a person with $2.5 million, what I'm going to be able to tell them is, based on your plan, based on finance and logic and history, this is exactly the path and the most efficient path of what you're going to do with your money. This is what makes sense insurance-wise, investment-wise, how much our weights of stocks to bonds are. But you have flexibility. You know, if you were to say, Mike, I like to have 400,000 in the bank, you can say, that doesn't make a whole lot of sense finance-wise, but you've bought yourself the flexibility of choice. So you want to leave it there, more power to you, just leave it alone. I could tell that person, hey, don't even worry about long-term care. You're going to be able to eat that expense if that life event plays out. But if you want to buy the insurance, more power to you. You have flexibility of choice. Oh, you don't want to have a lot of exposure to stocks? Well, we really only need a 3-4% rate of return to accomplish your budget. That's fine. We don't have to have any more exposure. Those conversations with someone with 500,000, I got to be a little bit more of a tough guy. You know, I have to be a little bit more strict and say, we have to save at this pace before retirement, or we're going to have a big problem. You know, I know long-term care insurance is expensive, but if we don't have it, it's going to be catastrophic to the other person if we don't have it. You know, I know you're conservative, but we need this much exposure to the stock market to generate this rate of return, and we can accomplish that budget. So, you know, it's a lot more of me telling them what's necessary than it is, you know, that person of 2.5 million, I could be more flexible. That's really what it comes down to. Portfolio wise, you could have a little bit more fun in speculation. You know, for example, you know, you brought up something to me earlier this week. You know, we can have a little fun side bucket, and if we hit a grand slam, great. If we strike out, it's not catastrophic. You know, that person of 500,000, we don't have a fun bucket where I could say, let's spend 20,000. You know, let's see if you know, Chat GPT takes off, or you know, this sector looks like it's going to go crazy. We have to be very disciplined at the smaller dollar amounts. Does that make sense?
Yes, thank you.
You're welcome. You're welcome. Great question. Anyone else have any other questions? Awesome. Obviously, I am always here. So if you have any questions that pop in the head a little bit later tonight, just shoot me an email. We can always jump on a chat or a Zoom conversation. Well, thank you so much for coming tonight. I truly enjoy what I do. So this was been great as always. Thank you and have a great night.